Ryan Bolton here, local mortgage expert, ryanbolton.com. Today, we're going to talk about the exciting world of mortgage disclosures. A necessary evil, and honestly, they have gotten a lot better over the time I've been in this career. And I've been doing it since 1999, and for so many years of my career, you'd see these good faith estimates that were nowhere near what people were going to see at the closing table because they really had no weight to them. They had no comparison to them. They had no penalties if you misquoted or were way wrong. So they've changed that over the last few years. If you get a loan estimate, there's certain things that cannot change. They can't increase. You can't all of a sudden have a fee just come out of nowhere that you actually have to cover. So these loan estimates were designed to have a comparison tool for the consumer to compare to what they actually get at the closing table. And then if anything changes during the process, one of these estimates has to be reissued. So let's review what one of these looks like. It's called a loan estimate. So you'll have the date it's issued, the applicant's property address, sales price, the term. You'll have some basic information up here. The first thing I would look at is right here. Is the loan locked? Is the interest rate locked? When you lock an interest rate, you're locking that day's pricing. So that doesn't mean you don't go back to that day if you make changes or do more down payment or less down payment, or something happens with the credit score, something changes with the lock, you go back to that day's interest rate, and that's what you adjust off of. So it is something to keep in mind. You're not locking that specific rate. You're just locking that day's pricing, that day's rate sheet. So you can make changes to it if you want to pay more discount or less or make adjustments to it, but you only have a certain window, typically 30 days, to make any adjustments and fully close your loan. So most locks are done for a 30-day period, and it is calendar days, not business days. So you want to check that right real quick just to see if the loan is locked. If you wanted it locked or thought it was locked, and it's not, you may want to have a conversation with the lender and just say, hey, I thought my loan was locked. What are interest rates doing? That type of thing. So then you have the loan term, the interest rate, the principal and interest, and you'll see these little yes and no boxes here. This is just to tell you right up front if the loan's adjustable, if it's a balloon, if there's a prepayment penalty, if anything about your loan's going to change over the 30 years of having the loan. And if one of these boxes is yes, they have to issue you additional disclosures on what is yes. Why will my rate change? Why will my loan amount change? What will change? Next, you're going to have projected payments. They're always going to have a breakdown of the first 7 years and then what happens after that. The most common thing you see that gets dropped off is mortgage insurance. Unless it is an adjustable rate mortgage, then it can tell you what your payment might look like after the adjustable period. But typically, you're going to see the principal and interest, mortgage insurance, and your escrow account, and then that drops off. The mortgage insurance drops off. Included in your escrow account most commonly is taxes and insurance. You'll see this other box. This could be for other insurances or other things that are escrowed. The most common thing you see here is the HOA or homeowners association. Now, with an HOA, it's not included in your mortgage payment. So your payment's still going to be this. They'll just add to this to have it be the total payment for that house, even though the HOA is an escrow. It's not part of your monthly mortgage payment, so they don't collect the money and then pay the insurance or pay the taxes. So the escrow account is just really an account that builds up over the course of the year. Like here in Utah, the property taxes are due in November. So what they do is they just take the tax amount divided by 12, add that to your payment. So every time you make a payment, you're making a 12th of a payment into your tax account. So when the taxes roll around, there's enough money to cover it. So it's really a great, useful tool to make it to when you make that mortgage payment, you're covering some of these other expenses. Next, you're going to have an estimate of the closing costs and your estimated short to close. This could be a combination of down payment, closing costs, minus your earnest money or any credits from the seller. So it gives you a rough idea what you should expect at least at the initial stages of what's projected that you'll need to bring to closing. Next, you'll have a breakdown. So you got this number here, this 8,000. This is where it breaks down where those numbers are coming from. You have your charges to get the loan, which is application fees, processing, underwriting, and any points used to buy down the loan. Now, that's something that can change. So let's say up here, you're not locking the loan and you decide you want to pay some points or the market changes to where you can buy down your interest rate. This number can change if it's a bona fide discount point. But once they lock the loan, they still have to send you an updated loan estimate if any of these numbers change. Next is sections you can't shop for. So typically these are third-party fees, but they are paid through the loan or through the proceeds that are third-party vendors like appraisers or you've got credit report fees or other things like here, like flood cert, tax monitoring. There's all these little fees that are associated with it. I've seen a lot of underwriters that'll just kind of lump it all in here and just raise this amount, or they'll itemize them out. Just depends on which mortgage company and the way they want to handle their accounting. But any of these fees for third-party services have to be the actual invoice. So it can't be something where we quote you $405 for the appraisal and it's only $350 and we keep the difference. Anything that's a third-party fee of one of our vendors, we have to match exactly what their invoice is. Next, you're going to have services you can shop for, which would be like a pest fee, a survey, or title insurance. You can use any title company that you want. A lot of times we'll recommend a title company. They're usually people we work with on a daily basis, so we have good systems in place as part of our teams to have title companies, but it is something where you can pick whatever title company you want to use. So these fees here can change up to a 10% variance. So we do have to get an accurate number, but if it's wrong, we have a 10% cushion. If it's more than that, we have to eat it. So generally, we have templates and we know what these fees are to where we even pad them a little bit until we know exactly where our final numbers are going to fall. Then up here, you're going to have recording fees. You're going to have the insurance prepaids for homeowners insurance, for the escrow account, for the upfront insurance. You're going to have the property taxes, those things that get escrowed right when you first buy the house. So these are all just to make sure that, again, by the time these things go to renew, you have enough money in your account to cover those. Then you have an owner's policy that's typically covered by the seller, but it is still something they want to disclose what that fee is. Then you have right here your total costs, minus any down payments, any deposits or credits, and you have your total estimated short to close. Next section, it will have a couple little comparisons of how much you'll pay in interest over the first 5 years, what your annual percentage rate is. So again, this is not your interest rate. It even says right here, this is not your interest rate. It's not the note rate. It's simply trying to express to you the cost of getting the loan in a percentage term so you can compare the fees and rate of another lender to what we're charging you, or it's just a comparison tool. It's something where you can say, okay, if my APR is 4.5 and his is 4.247 or 2.74, but we have the same starting rate, that means the fees are different. So it's a way to be able to compare the difference between not only the interest rate, but the fees to get that interest rate. So it's a comparison tool, simply that. Next, you're going to have some other things about appraisal, if the loan's assumable, maintaining homeowners insurance, if there's a late payment, what happens when you refinance, and who is servicing the loan, whether it's serviced by this lender or whether they're going to sell the servicing. And then you sign it. Typically, it's signed digitally. Yeah, I've seen it signed physically as well, but a lot of times these initial ones are at least electronically signed to start the waiting periods and just get the initial ball rolling, knowing that this is designed to be worst case. We're still gathering information. We don't have all the final numbers yet, but generally we have a good idea what these numbers will be unless something changes with the loan amount, sales price, or something like that. So next, after the loan estimate, before you go to closing, you're issued what's called a closing disclosure, commonly called a CD in our industry now. A lot of times that's what you'll hear agents say. Maybe you'll hear your agent say, hey, have you issued the CD yet? That CD has to be issued within 3 business days. So let's take a look at that next. All right, let's take a look now at the closing disclosure. This is the final disclosure that you'll receive 3 business days before you go into the title company or have a notary come to your home or office, depending on how you're signing your final loan. Generally, most people go to a title company, but I've seen notaries that go to home offices and stuff like that as well. But this is the disclosure that gives you a final comparison between the loan estimate and what you'll actually sign at closing. So this one you want to spend some time to review and make sure it's right. So let's see some of the things that changed from the loan estimate. If you remember, we had the loan estimate here. Now you've got the closing disclosure. Very similar forms. They wanted to have them match pretty close because they want to be able to make it easy to compare the 2 different forms. So you'll see a little additional information on here. You'll have the seller information. You might have some of the more of this stuff kind of filled out once you know what it is. Because usually when you get the loan estimate, you may not have all the information. You're kind of that very beginning stage. So the closing disclosure is just gathering the final culmination of all the work it took to get to this stage. So you'll see the final sales price, if that changed, loan amount, interest rate, your principal and interest, whether there's a prepayment penalty, a balloon. It's all the same kind of stuff that you saw in the loan estimate. If any of those things happen to change, you do see something here. I noticed on this one, it looks as if after they did the initial loan estimate, that there was an HOA. So they had to add that monthly payment. It doesn't get added to here because the HOA is not part of your mortgage payment, but it is part of the debt ratio to make sure we account for that expense on the house, but it is paid separate. It's not something that's escrowed. Most of the time, escrows are once a year payments or maybe every 6 months, depending on the property taxes. So for instance, here in Utah, the property taxes are always due in November. So it's once a year. So as you make this payment right here, a portion of that, this $206, goes into a separate account that builds up to when the taxes and insurance are due. There's enough money to cover that. Where the HOA is due every month. Typically, it's due every month. So it's not something that gets included in the monthly payment, but it is a disclosure here of what that total payment's going to be. Then you have your final breakdown right to the penny of what your closing costs are and your final out-of-pocket expense to purchase the home. We call it short to close. So your short to close is going to be a combination of the down payment plus the closing costs minus any credits that you received, like your earnest money deposit or credits from the seller. So now let's go to the next page here. Okay. So now it breaks down the closing costs. It's a little different because now it's going to show who paid what. So if there's anything that was paid before closing, at closing, or the seller covers, and we'll kind of disclose that. So you can see the appraisal fee was paid by others. So maybe this was paid by out of pocket or just before. Maybe the seller paid for it. So that's how that gets separated out, who actually paid that expense. So, and then you've got your title fees. You're going to have your government fees for recording. You're going to have your escrow account. Typically, you're going to see this. You're going to see the first 12 months of the insurance covered at closing. Then as you make your payment, you'll add to that account where next year when it renews, there's enough money to cover the account. So generally, that's not really a closing cost. It's just kind of part of funding your escrow account to make sure you have enough money to cover the insurance. And then you'll see a little padding right here because the first payment on the loan isn't due until usually about 45 days later. They have to make sure there's enough in the account to cover any taxes and insurance. Then you can see here, when there's an HOA, there's usually going to be a transfer fee or some sort of fee to change ownership. This is what you'll see as well, is what's called capital contribution. So let's say there's a project within the HOA that all the owners agree to. Maybe it's putting a pool or maybe fixing the pool or some other large capital investment that they've agreed to pay, that now you're the buyer, you would be responsible for that unless you negotiate it as part of the price or something like that. So it's really crucial when you're in an HOA to get disclosure on what's going on with that HOA, so you don't get stuck with a $500 bill that might be something that the seller was supposed to cover. You'll see here that some of these fees are moved to the seller side, like the commissions, and home warranty is typically on the other side. It looks like there might have been some sort of engineer fee on this, which is interesting. So it looks like they did some sort of split of some engineering that was needed to be done. Maybe the home inspection turned something up. So that's pretty interesting on an example there here that they would throw some of that stuff in there. But this is the stuff that can happen. That's why there's a difference between the loan estimate and the closing disclosures. We can find this stuff up as we go through the process, as we get a home inspection, an appraisal, home warranty. All those things can kind of trigger the need for some other disclosures. Down here, you'll see an estimate. So right here, it's calculating the cash to close. It's going to give you a breakdown between the loan estimate you got at the beginning and the final one, and do a side-by-side comparison. If any of these numbers are dramatically off, there has to be a refund to correct the number. So it allows for some cushion. There's some things that can change up to 10%. Other things cannot change at all. So it is designed to try to be worst case. So as you can see here in this scenario, they actually did bring in less money because some credits were negotiated, but it does look like the overall cost actually did go up. So, but generally when I'm trying to do a loan estimate, I want to make the numbers kind of worst case. And as we go along, they get better because I want to try to make sure my numbers don't get thrown way off. It's a lot easier for bring less money to closing than a whole bunch more. It's always better to have the payment higher than and make it go down. So I always try to make sure the numbers are padded a little bit. Here's another breakdown of the fees. So it's the same fees, just a little different type of summary, a little more traditional settlement statement. This is kind of what they used to look like. So they kind of integrated the old one with the new to kind of ease the transition. And a lot of people were used to seeing these numbers instead. So just gives you another breakdown of of where the closing fees are going. Then you have additional information. It's going to talk about demand features, which means that the payment's due right then, or the lender can just demand that the loan's due. You have assumptions, means that somebody can just assume or take over the loan. This is very common with FHA loans, but most loans are not going to be assumable. It talks about an escrow account, that where the money goes and how it goes in and out. It talks about late charge. You have a 15-day grace period. You got negative amortization. So it's going to break down whether the loan has a negative am feature. Most loans are not going to have that. And then whether you can make partial payments on your loan. It also talks about where the security interest is and where to make your payments and keep the property maintained. You have a breakdown here of total payments. So it'll show you the total payments of the life of the loan versus the finance charge based on the amount you've financed and what the total amount of interest you'll pay over the entire life of the loan if you keep it the full 30 years. Then you're going to have a section right here that's going to have all the information of whoever was involved in the transaction, the buyer's agent, the broker, the settlement agent, which is typically the title company, especially here in Utah. And then you're going to have the lender's information, which will be my information. So that way, if there's ever a dispute or issue with the form or fraud that's discovered, our information is going to be easy to get to. So they can call us and say, hey, what did you know about, in this case, Mr. and Mrs. Smith? What was going on? Maybe that's not the borrower's name. That might be the loan officer's name. Oh, it's Joe Smith. All right. Joe Smith, loan officer. He'll have his loan number, all that, or loan amount, or sorry, loan ID, the NMLS ID number will be on there as well. And there you go. So that's the closing disclosure. So you can see it's very similar to the loan estimate, and allows you to break down and really compare the two different forms. And these forms are the same regardless of the lender. So it's not like these are only the forms that we offer. These have become standard as required documents to do mortgage loans in America, in the United States. So it is something that these are required forms. So it allows you to shop and allows you to compare at the end what you actually thought you were getting. So I hope that was helpful. Let me know what you think of the video. Let me know of other videos you'd like me to do. Any questions you have about these forms, you can post comments below and I'll answer those questions for you. Or we can do other videos if we want to go into a little further detail of how these forms work. So these are forms I just pulled directly off the consumerfinance.gov website, which is the CFPB. It's one of the regulators for our industry. They're a little out of date, and they actually have some interesting numbers on here you don't typically see, but they probably ought to update the examples in here. But I just thought they're the governing body, so why not use their examples? Anyway, let me know if you have any questions, comments, concerns. Love to see you in another video. Post and comment, share, and we'll see you next time. Thanks.